Hi, welcome to this Tuesday's topic and Tuesday talk. This week been a turbulent week, turbulent start to the week. Last week ending was also quite turbulent. So let's see how the rest of the week pans out. We have an important event coming up tomorrow, which is the Fed FOMC meeting. But my aim today is we're going to be talk to you about the big picture. We'll get into that once we cover the factor and the sector overview and the risk model. So this time we are going to go in a different order just to change things up. It's about us. The factor performance. Factor performance last week, value dropped a little bit. Small caps took the largest hit, with the broader market also finally taking a hit in line with small caps. Quality was down 2%, so everything in the range. On a monthly basis, uh, small caps still the worst performers, followed by momentum. Value somewhere in the middle at around 8%, and market and low volatility factors are down the least at about 5%. Year to date, nothing changes much. We're still, where the order remains the same. Small caps taking the biggest hit in officially, they've been in the bear market from their peak in October, and the market's also getting closer to that level, which is around 15,000 on the Nifty. If you were uh, wanting to get the technical definition of a bear market. With that, no surprises here again that no factors are in an uptrend. Uh, Out of the 7 factors that we track, all of them are in a downtrend. With that, let's get into the sector performance. Auto, surprise, interest rate sensitive, still doing a positive 1%. Is it related to the chip shortages? We hear a lot of anecdotal evidence that the waiting period for cars is fairly long. So perhaps related to that, pharma is flat, energy is flat, IT finance, metals taking the largest hit, banks and FMCG also surprisingly. For the month, again, auto is up while metals are down the most. Year to date, uh, energy is still up 14%, autos are up 4%, and FMCG is flat. IT is down the most at about 25%. Realty follows close at about 18%. So again, not much change from last week here, except a few numbers here and there. In terms of trend, sorry for that, but so FMCG has gone into a downtrend from last week. Uh, so auto still remains in an uptrend, energy remains in an uptrend, but FMCG has gone into a downtrend. So that's one change from last week. So 2 sectors up, 9 sectors down. If you want all of these in your inbox, please subscribe to factorinvestor.substack.com and you'll get this in your inbox. This is our factor all-weather alpha model, which on the 1st of May, as you can see here, that it went into completely into risk-off mode. So for the last 2 months, we see the turbulence in markets. Gold, to be honest, also has not done much. It's been flat to down a bit, but nothing compared to what the markets are doing. So good call by the model, and we remain there in the risk of tactical risk of model. With that, let me come to the topic of the day, which we've been covering in our last two videos. We've covered behavior gap, quantified it. We've looked at some of the behavioral biases, disposition bias, confirmation bias, how much have investors lost. But today, let me show you, how to counter that. And one of the ways to do it is Don't interrupt. If you're a non full-time investor, this is not your main job. This is not your day job. You're an IT professional. You are a lawyer. You're a doctor. Even if you're a chartered accountant. Even if you are a private equity investor, venture capitalist. This is not. Markets are not something that you should be tracking on a weekly, daily basis. That's not what you should be doing. So don't interrupt compounding. Have a plan and follow that plan. Now, the other factors that cause a behavior gap are external, and that is noise, which is in the media, volatility that we are seeing currently. There's a lot of chatter in social media, on Clubhouse or on Twitter Spaces, and that all that makes us think a bit short term, and that we end up interrupting the most important element of long-term investing, and that is the impact of compound interest. And I'll show you that on the next slide. Uh, equity markets have survived many once in a 100-year events. So you may hear that, oh, tomorrow the FOMC meeting is the most important thing that has ever happened. No, it's not the most important. It is important in the short run, yes, but not over the long run. It's just one of the many things that are going to happen. Markets will deliver non-linear returns. They will not, when we say compound, we do, markets are not going to move on a linear basis, giving you 2%, 10%, 12% every year on year. No, it might be minus 20% in one year, plus 40 in another year, minus 10 in one year, minus 5 in the next year, and then suddenly go up another 40% in the third year. That's the nature of equity market. That's the journey that we have to go through to earn those premium returns. Remember, there's no pain, there's no premium to be earned there. Let me leave you with this graphic from 1990 to 2021, the journey of Indian equity markets. It's a very telling graphic. Sometimes if you feel that all is lost and nothing is working, and the world is in gloom and doom, I look at this graphic. I think you should too. This is from 1990 to 2021, and you can see that we've been through many crises in the past. In 91, I think we had to send gold abroad because we didn't have enough money to import oil and pay the World Bank. In 2000, we had the tech bubble. In 2008, we had the global financial crisis. In 2016, we had demonetization. In 2020, we had the COVID pandemic. Over all these years, 30 years that the market has been around, sorry, small typo there, but they've gone up almost 50x. This is a return of 14% per annum, which is far higher than what inflation has done, even on a realistic basis. So equities are the most powerful tool to get inflation beating returns, provided we don't get into the way and interrupt compounding. You have to remember that you have to continue your long-term investing plan and not get sidetracked by short-term noise. And for that, you have to educate yourself about markets. You have to observe markets long-term. You have to build your own conviction and your own faith and belief. Talk to an advisor. A lot of resources available online, but do that. So with that, just a general disclaimer that it's not investment advice, purely for educational purposes, and please consult an investment advisor for investing. You can follow me on Anish Daily, QED Cap, and you can visit us on QEDCap.com. Thank you, and see you next week.